with John A.G. here. Monday's opening just happened, and we need to talk about everything that unfolded because this was significant. Gold has reclaimed $5,000 per ounce. Let me say that again. Gold is back above $5,000. After everything we saw last week, after the margin hikes, after the 31% crash in silver, after all the forced liquidation and panic selling, gold is sitting at $5,053 per ounce right now, up 1.4% from the previous close. Silver is up 6.1% in a single session, 6%. Silver is trading at $81.67. This is exactly what we discussed. This is exactly what the physical market was screaming would happen. The Asian session opened and it confirmed everything. Before we go any further, drop a comment below. Tell me where you are watching from right now. Are you in the US waiting for markets to open? Are you in Europe, Asia, Australia? I want to know where this community spans across the globe. Drop your location and drop with John A.G. in the comments so I can see who is watching and engaging with this content. Let us build this together. Now let me walk you through exactly what happened overnight and why this matters more than most people realize. China just reported that the People's Bank of China continued its gold buying for the 15th consecutive month in January. 15 months in a row. They are not stopping. Last month alone, China's gold reserves expanded by 40,000 ounces. Their total reserves now stand at 74.19 million ounces. The monetary value of those reserves has climbed to $369.58 billion. Let me put that in perspective. While paper markets were crashing, while margin hikes were forcing liquidation, while mainstream financial media was telling you the gold bull market was over, China was buying. They added 40,000 ounces. They did not sell, they accumulated. That tells you everything you need to know about who understands real value and who is playing paper games. And it is not just China. India's gold ETFs attracted $2.49 billion in net inflows in January 2026. That is up 98% from $1.25 billion in December. 98% increase month over month. January marked the 8th straight month of inflows for Indian gold ETFs. 8 months in a row of consistent buying. While paper prices crashed 31% in a single day, real investors in India were pouring nearly $2.5 billion into gold funds. The physical world and the paper world are telling completely different stories. One of them is lying, and Monday's opening just showed us which one is telling the truth. Now, I know some of you are new here, so let me be clear about something. I do not sell signals. I do not sell mentorships. I do not sell memberships. I do not sell anything. If anyone ever reaches out to you claiming to be me offering any of those things, block them immediately. I only share analysis here on this channel. That is it. I am not here to sell you fear. I am not here to sell you greed. I am not here to tell you gold is going to 10,000 or that it is going to crash to 2,000. I am here to show you the data, both sides, what is happening in the markets, what the institutions are doing, what the physical market is saying, and let you make your own decisions. That is all I have ever done here, and that is all I will ever do. So let us connect what happened Monday to everything we have been tracking. Last week, we saw silver crash 31% in a single day, the biggest daily loss on record. We saw CME hike margins twice in 72 hours. Gold margins up 33%, silver up 36%. We saw dealers shutting down because they could not source physical metal. Bullion Star said it was difficult to near impossible to source silver. Golden State Mint shut down silver sales. Baird UK closed online ordering. The physical market was screaming that something was breaking. And what happened Monday? Gold reclaims 5,000. Silver surges 6%. The Asian session opened strong. Shanghai held. The margin hikes did not break the bull market. They did not break physical demand. They did not break China. They did not break India. The physical reality won the opening round. Let me give you the exact data because the numbers matter. Gold on COMEX last traded at $5,053 per ounce, up 1.4% from the previous close. Silver at $81.67, up 6.1%. Now compare this to what we were looking at last week. Silver was trading at $85 before the crash. It dropped to the low 60s intraday during that 31% collapse, and now it has bounced back to 81. That is a significant recovery. That is not a dead cat bounce. That is buyers stepping in. That is the physical market reasserting itself against paper manipulation. And here is what is driving this move. The dollar is weakening. The US dollar fell against a basket of major currencies, and that is lifting precious metals because commodities priced in dollars become cheaper for overseas buyers when the dollar falls. But there is something bigger happening here. Fed independence is under direct attack. President Trump indicated on Saturday that he might take legal action against his new Fed chair nominee, Kevin Warsh, if Warsh declines to lower interest rates. Let me say that again. The President of the United States is threatening legal action against the Federal Reserve Chair if he does not cut rates. And it gets worse. Treasury Secretary Scott Bessent on Thursday did not dismiss the potential for a criminal investigation into Warsh if he refuses to implement rate cuts. This is unprecedented. The independence of the central bank is being openly challenged at the highest levels of government. And what happens when faith in central bank independence erodes? What happens when the institution that controls the money supply becomes politically compromised? Gold goes up. That is what happens. Gold is the ultimate hedge against institutional breakdown, and we are watching that breakdown happen in real time. Now drop another comment for me. What do you think happens if the Fed loses its independence? What do you think happens to gold if rate decisions become political tools rather than economic policy? I want to hear your thoughts. Drop with John AG in the comments along with your take, because I read these comments and they help shape what we discuss in future videos. Let us talk about silver, because the volatility we are seeing is unlike anything in recent history. Silver recorded a 27.8% intraday range on Thursday. Let me put that in perspective. The typical daily movement for silver over the last 6 years has been just over 2%. 2% is normal. 27.8% in a single day is extreme. That is more than 13 times the normal volatility. And here is something that should make you pay attention. Silver's 1-month implied volatility is now higher than Bitcoin's. Michael Brown, senior market analyst at Pepperstone, pointed that out specifically. Silver, the metal, is now more volatile than Bitcoin, the cryptocurrency famous for its wild price swings. What does that tell you? It tells you something fundamental is happening in the silver market. This is not normal price action. This is a market under extreme stress. And when markets are under extreme stress, either something breaks or something explodes to the upside. There is rarely a middle ground. Silver failed to sustain its rise above $90 an ounce last week. That was the resistance level that got rejected. But look at where we are now, $81.67, recovering from the lows, building a base. The question is whether silver can consolidate here and make another run at 90, or whether we see another wave of selling first. I am watching the $80 level closely. If silver holds above 80, that is bullish. If it breaks below 75, that opens the door for more downside. But here is what the analysts are saying. Barbara Lambrecht, commodity analyst at Commerzbank, said market participants are still seeking guidance in the precious metals sector. She expects price fluctuations to remain high for the time being, but considers precious metal prices to be well supported in the medium term. Michael Brown at Pepperstone anticipates that any dips will likely be purchased. That is the key phrase, dips will be purchased. The physical buyers are waiting. They are not selling into weakness. They are buying it. And here is something fascinating that most people are not talking about. The algorithmic trading funds, the CTAs, the machine learning hedge funds, they are making a fortune on these precious metal swings. The SGCTA index, which is the main performance benchmark for commodity trading advisors, rose 5% in January. The SG Trend Index, which tracks the 10 biggest trend following hedge funds, advanced 6.9% by January 29th. That made January one of the best months for the index since 2000. These are computer-driven strategies that use statistical models and machine learning algorithms to identify trends and bet on them. They rode the gold and silver rally up, and they managed to sidestep much of the sell-off. How did they do it? They de-risked when volatility spiked. John Kaplis, founder of Pivotal Path, said most strategies have been reducing precious metals positions since September as volatility continued to increase. They benefited significantly on the way up while mitigating some of the losses during the sudden reversals. That is smart money management. And despite the sharp correction, both benchmarks remain up more than 4% year-to-date as of February 4th. The quants are still bullish. They are still positioned long. They are just managing risk better than most retail traders. Andrew Beer at Dynamic Beta Investments said it perfectly. CTAs are nimble and flexible. The sharp reversal in gold and silver last week will cause many to de-risk, but most will still bet on further moves upward. CTAs were early, contrarian, and right about gold and precious metals. Last Friday's reversal was merely giving back some profits. That is the institutional perspective. They see this as profit-taking, not the end of the bull market. They see this as a normal correction within a larger uptrend, and they are positioning accordingly. Now let me talk about something that is affecting silver specifically. Silver has taken on characteristics of a meme trade: low price relative to gold, low liquidity compared to other major commodities. These are the prerequisites for explosive retail-driven moves, and that is exactly what we have seen. Yongshin Kung at Mast Investments pointed out that a good meme trade requires low price and low liquidity, and that conflicts with what most trend-following strategies need. Many CTAs were probably just outright excluding silver because it does not have the liquidity they naturally look for. So while silver skyrocketed in January, many professional money managers missed it because they were not playing in that market. But here's the flip side. That meme dynamic also contributes to the violent reversals. When retail piles in and then panics out, you get 31% daily moves. That is the trade-off. Now, I want to be completely fair here and present the other side of this, because that is what I always do. Let me give you the bearish case first. Despite Monday's recovery, there are real headwinds. Improved investor confidence in riskier assets, driven by easing Middle East tensions, is creating a positive trend in equity markets. When stocks look attractive, money flows out of safe havens like gold. That is basic portfolio rotation. And right now, risk appetite is returning. The fear from last week is subsiding. People are looking at equities again. That diminishes the appeal of precious metals in the short term. Additionally, traders seem reluctant to place aggressive directional bets ahead of major economic data. We have the delayed non-farm payrolls report coming Wednesday. We have consumer inflation figures coming Friday. These are market-moving events. And until that data comes out, many traders are sitting on the sidelines. They do not want to be caught on the wrong side of a major data surprise. So we could see choppy, directionless price action for the next few days until the data clarifies the picture. The NFP report on Wednesday is particularly important because it will provide insight into the Federal Reserve's trajectory for interest rate cuts. Right now, traders are pricing in a higher likelihood of the Fed reducing borrowing costs at least 4 more times in 2026. That expectation was reinforced by last week's indicators of labor market weakness. But if Wednesday's jobs report comes in stronger than expected, that could shift expectations. Fewer rate cut expectations means a stronger dollar. A stronger dollar means pressure on gold and silver. So there is real event risk in the next few days that could push metals lower before any sustained rally. And there is still the matter of the margin hikes. CME raised requirements twice in 72 hours. The cost to hold positions is significantly higher now. Any traders who were over-leveraged going into last week and somehow survived the crash now face even more expensive margin requirements. If they cannot meet those requirements, they will be forced to liquidate. That could create another wave of selling. The margin situation is not resolved just because Monday opened green. The pressure is still there. The clearing firms are still nervous. And if we get another volatile session, we could see more forced selling cascade through the market. But now let me give you the bullish case because it is equally compelling, if not more so. Gold just reclaimed $5,000, the psychological level that everyone was watching. It did not just hold, it moved above it. That is significant. When key levels get reclaimed after a sell-off, that signals buyers are stepping in. That signals confidence is returning. 5,000 is not resistance anymore. It is becoming support. China is still buying. 15th consecutive month. They are not stopping. They are not selling. They are accumulating. And they are not buying paper promises. They are taking delivery of physical metal, 40,000 ounces last month alone. When the second largest economy in the world is consistently buying gold month after month, that creates a floor under prices. That is structural demand that is not going away based on daily price fluctuations. India is still buying. $2.49 billion flowed into gold ETFs in January, up 98% from December. 8 straight months of inflows. Indian investors understand gold. They have for thousands of years, and they are buying more now than they have in years. That is the physical market speaking. That is real demand from real people with real money, not paper contracts, not leveraged futures, actual capital flowing into gold exposure. The dollar is weakening. And when the dollar weakens, gold strengthens. That is the historical relationship, and it is playing out right now. Dovish Fed expectations are dragging the dollar lower. Concerns about central bank independence are dragging the dollar lower. And both of those factors are providing support to gold. The macro backdrop is bullish for precious metals even if day-to-day volatility remains extreme. Silver is recovering. 6% in a single session is not a dead market. That is a market that is very much alive and fighting back against the paper suppression we saw last week. Yes, it failed at 90, but it is building a base in the low 80s. And every time we have seen silver get hammered and then bounce back, It has eventually gone on to make new highs. The pattern is clear to anyone willing to look at the long-term charts rather than panicking over daily moves. And here is something else that is bullish. The trend following quants are still long. Despite the volatility, despite the sell-off, they are still positioned for higher prices. Nicholas Gaussel at Matori Capital said the silver retreat had limited impact on industry performance. CTAs are currently benefiting from trends not only on metals, but also on other sectors. The environment turned pretty favorable in Q4, combining trends and diversification. These are sophisticated algorithms managing billions of dollars, and they are still betting on precious metals going higher. That should tell you something. Now let me tell you what I'm watching for the rest of this week. Wednesday's NFP report is critical. If jobs come in weak, that confirms the labor market is softening and supports the case for more Fed rate cuts. That would be bullish for gold and silver. If jobs come in strong, that complicates the rate cut narrative and could strengthen the dollar short term. Friday's CPI data is equally important. If inflation comes in hotter than expected, that creates a dilemma for the Fed. They want to cut rates, but they cannot ignore rising prices. That uncertainty could drive safe haven demand into gold. If inflation comes in cooler, that gives the Fed cover to cut more aggressively, which is also bullish for metals because it weakens the dollar and increases the appeal of non-yielding assets. The Fed independence situation needs to be monitored closely. If there are any further statements from the administration about legal action or investigations into Fed officials, that will shake confidence in the entire monetary system. And when confidence in the monetary system breaks down, gold is the beneficiary every time throughout history, no exceptions. And I am watching the physical market. Are dealers still struggling to source metal? Are premiums still elevated? Is Shanghai still trading at a significant premium to COMEX? These are the indicators that tell us whether the disconnect between paper and physical is widening or narrowing. If physical premiums stay high while paper prices stabilize, that tells us paper is undervalued. If physical premiums collapse while paper rises, that tells us the markets are coming back into alignment. Right now, the physical market is still tight. Until that changes, I remain constructive on precious metals. Now, before I give you the key takeaways, I want to ask you something. For those of you who have been watching this channel for a while, has this content helped you navigate the volatility we have seen? Has understanding both sides of the trade helped you make better decisions? If so, take a second and hit that subscribe button. I know a lot of you watching right now are not subscribed. That is fine. I do not chase vanity metrics. But if this content adds value to your process, subscribing is how we grow this community. It helps the algorithm show this to more people who need to see it. It helps us build something based on substance, not hype. So if this is useful to you, consider subscribing. If not, no hard feelings. I will keep doing what I do regardless. Here are your key takeaways, and we are out. First, gold has reclaimed $5,000 per ounce, up 1.4% on Monday as the Asian session opened strong. China continues buying for the 15th consecutive month, adding 40,000 ounces in January. India saw $2.49 billion flow into gold ETFs, up 98% from December. The physical market is not panicking. The physical market is buying. The margin hikes did not break the bull market. Monday's opening proved that. Second, silver surged 6% to $81.67. The recovery from last week's 31% crash is underway. Volatility remains extreme, with silver now more volatile than Bitcoin on a one-month implied basis. But analysts expect dips to be purchased. CTA funds are still positioned long. The trend following algorithms that made money on the way up are still betting on further upside. Silver needs to hold $80 as support. If it can consolidate here and build a base, 90 becomes the next target. Third, Fed independence is under direct threat. The president is threatening legal action against the Fed chair if he does not cut rates. The Treasury Secretary is not dismissing criminal investigations. This is unprecedented in modern American history. And when faith in central bank independence erodes, gold benefits. That is the historical pattern. That is what we are likely to see play out. Additionally, Wednesday's NFP and Friday's CPI will provide major catalysts. The dollar is weakening. Rate cut expectations are rising. The macro backdrop supports precious metals. But short-term volatility remains elevated and event risk is high. The unresolved tension is this. Paper markets showed extreme violence last week. Margin hikes forced liquidation. Prices crashed 31% in a single day. But physical markets remained tight. Dealers could not source metal. Premiums stayed elevated. China kept buying. India kept buying. And Monday's opening showed the physical reality reasserting itself. The question is whether this continues, whether the paper manipulation has exhausted itself, or whether there is one more wave of selling before physical completely overwhelms paper. I do not have a crystal ball. Nobody does. Anyone who tells you they know exactly what is going to happen is either lying or trying to sell you something. What I can tell you is what the data says, what the physical market says, what the institutional positioning says. And right now, all of those indicators suggest the bull market in precious metals is intact. Friday was a shakeout, Monday was a recovery. What happens the rest of this week will depend on the economic data and whether the Fed independence crisis escalates. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your timeframes. Are you trading on an hourly chart or investing on a yearly thesis? Plan and position accordingly. If you are overleveraged, you will get destroyed in this volatility, regardless of whether the long-term thesis is correct. Position sizing matters. Risk management matters. Do not let greed or fear make your decisions for you. Use logic, use data, and make your own choices. Drop your thoughts in the comments. Let me know where you are watching from. Let me know what you think happens next for gold and silver. Let me know if this content is helping you navigate the noise. And if you found value here, consider sharing it with someone else who might benefit. That is how we grow. Not through hype, through substance, through community. With John A.G. Out and about.